Welcome to this lesson where we'll talk about analyzing investment costs. The investment costs are a relevant component to the financial analysis of an investment project. The lesson is organized as follows. We'll have first a brief introduction. Then we'll talk about one of the main aspects of investment costs that are fixed assets. Then we'll talk about pre-production expenditures, that is another component of the investment costs of a project. Then we'll discuss contingencies that are related to unforeseen higher costs and expenditures in the life of a project. Then we'll focus on net working capital, on the main issues, that is another component of the project investment costs. And then we'll give a look at depreciation that is important to understand the dynamics of the investment costs over the life of a project. So let's start from the introduction. In this introduction, we define what we mean for initial investment, and in particular, we can say that the total initial investment is given by the sum of fixed assets, pre-production costs, and investment in net working capital. So a given investment project is requiring an initial expenditure for the initial investment, and this investment is made mainly of three parts. The fixed assets that you have to buy in order to start the project, and then we'll define in detail what we mean for fixed assets. Then what we define as pre-production costs, that are all the costs that the firm or the organization is to sustain in order to start the project and before the start of the project. And finally, we have the initial investment in net working capital that is related to the short-term assets that are needed for the operations of a project. The sum of these three components defines what we intend here as initial investment of a project. So let's start from the fixed assets. So what we mean in general for fixed assets? So fixed assets are assets that have a long-term life. So they are used for several years during the life of a project. And conventionally, from the point of view of the balance sheet, you define a fixed asset as an asset that is alive longer than 1 year. So from an accounting perspective, fixed assets are not expensed to the income statement, but they are capitalized in the balance sheet and then depreciated. We'll look at these specific aspects in the end of this class when we'll talk about depreciation. So what are the different types of fixed assets that a firm or an organization has to buy in order to start a new project? First, land. If you need to build, for example, a new industrial site, or you have to build a new exploration field for oil, clearly you have to buy the land where to build industrial site or to start the exploration activities. Then you have the cost for the site preparation development, in the sense that once that you have the site, you have to prepare the site for the activity you intend to perform then on that site. And there are some costs that you have to sustain before or at the moment you start the project that have a long-term nature, clearly, because then you will benefit from these costs for the whole life of the project. Then clearly you have the buildings. This cost refers both to the existing buildings that are bought or to the buildings that are newly built, so built that did not exist and were specifically built for the purpose of this project. And clearly all the plant, machinery and equipment that will be used for more than 1 year of the life of the project. So Also in this case, these are assets that will not just use it for 1 year, but will be used for several years during the life of the project. And moreover, these assets, as we'll explain later, will be consumed during the life of the project. So in other words, from an accounting point of view, they will have to be depreciated according to their consumption rate. Then we have any other fixed assets that is employed in the project, so any other asset that is bought for this project and then used for more than 1 year. We could have, for example, vehicles, trucks, and any other assets that can be useful to the realization of this project. And finally, you have a specific category that is very interesting of fixed assets, that is intangible assets. So all the assets that we mentioned so far are typically an intangible asset, in the sense they have tangible nature, they are physical assets. But for the realization of a project, you can also need intangible assets. Intangible assets are typically patents, trademarks, licenses, all the assets that, in other words, have a long-term life, but have not a physical nature, but however, are needed for the realization of the project. For example, if you are investing in the development of a new product to bring on the market, you could need a patent in order to protect your new product from competitors and imitation. So in this case, the patent will be used for the whole life of the project, and therefore it's a fixed asset, even though it is not a physical nature. The same is true if you buy a trademark in order to commercialize a given product in a new market. This is a long-term asset that has not a physical nature, so it's a fixed asset but with an intangible nature. What is important to remark here, even though we cannot enter into details for time reasons, is that sometimes intangible assets have a different treatment from an accounting point of view as compared to tangible assets, because not always intangible assets can be capitalized into the balance sheet, but sometimes they are expensed in the income statement depending on the specific national accounting regulations. But if you are planning a cost to buy a patent or a trademark before or during the life of the project, clearly this is a fixed asset as well, the tangible fixed assets. Then the second component of the initial investment required for a project is pre-production expenditures. Pre-production expenditures are made by two components. One is preliminary expenditures, the other is pre-operative expenditures. But both of these two categories are expenditures that are sustained before that the project starts. Let's look at the first component of the pre-production expenditures, that is in particular preliminary expenditures. So what do we mean for preliminary expenditures? First of all, company registration charges. That are the charges that you need in order to incorporate a new company. So this charge clearly depends on the national rules, the amount of this charge. Sometimes you could not need to pay a registration charge, for example, when the project is realized by an existing organization. So in this case, clearly the firm has already been incorporated, and so you don't need any company registration charge. But if you are planning to create a new company to realize this project, in this case, you will have to consider as initial investment also the registration and incorporation charges for the new firm. The second component of preliminary expenditure is fees and costs for issuing new capital. What does that mean? As we explained in the previous class, in order to realize a new project and to buy the fixed assets and to raise the new capital, you have to ask investors to provide money. So raising these financial resources that are needed for a project sometimes can be costly. This cost is higher when you have a more complex financial structure. For example, when you create a new company for the realization of that specific project, so the new company has to raise the new financial resources with quite a complex financial structures, the cost to raise new capital will be higher. On the contrary, if the project is realized within an existing company and the money is provided by the cash available to the company, then clearly you will have no cost for issuing new capital because the firm has already the capital needed for the project. So also this component of preliminary expenditures will depend on how you intend to fund the project that you are analyzing. Third preliminary expenditures is related to the preparatory and feasibility studies. Before starting a new project, you could need more information about the underlying technology or the market where you will sell your products. So you could ask a consulting firm to provide you with the preparatory and feasibility study that provides you with more information about the clients, potential prices, about the technology, competitors, and so on. So clearly, in order to have this information, you have to sustain a cost, and this eventually is included into preliminary expenditures that are a component of the initial investment for a project. The second component of pre-production expenditures is operative expenditures. Here you have, first of all, pre-production marketing. This item refers to all the costs that the firm incurs in order to advertise the product and to start the campaign to sell the product on the market when the product will be available. Then you have trial runs. That is important component when you have a new product. So before being able to sell the products on the market, you should test the product if its technical features of the product are effective, and if the product responds to some specific regulations. It happens, for example, in the pharmaceutical industries, where a new drug has to pass all the clinical trials that are required by the national administration. So in case of new products or services, trial runs can be a long and expensive activities that has to be performed before the operation starts. Another component of operative expenditures is represented by training of the personnel. The training is particularly needed when the project requires the sale of a new product or a service. In this case, the employees could not have knowledge or previous experience with this product or service, and therefore some training could be needed before that the product is sold on the market. Other components of preparative expenditures are legal costs that are needed for setting the project structure and for the contracts that are to be signed before the project starts. And we have also eventual initial establishment costs related to the, for example, inauguration of the building or of the industrial site and so on. So if we want to summarize at this point, we can say that one important component of the initial investment required by a project is the pre-production expenditures. And pre-production expenditures are made of preliminary expenditures and pre-operative expenditures, which I have described so far. Now it's important to recognize that all the fixed assets and the pre-operation expenditure that we have described so far are the results of an estimation. But it can happen that the investment required by the project could be higher than what we expected. So this is why typically it's fair to include in our estimation contingencies. So contingencies are intended as possible variations to the initial investment due to unforeseen causes that at the moment you are not able to predict, but that in the reality could affect the real investment required by the project. So we can define contingencies as the provision for unforeseen expenditures and price increase. So it's a way to adjust our estimation of the initial investment to account for unforeseen events that can increase our expected initial investments. And we can distinguish two types of contingencies. We have physical contingencies that are related to the design or the product or the productive process. What does it mean? It can happen that if we are developing a new product, the design of the product will change as compared to the initial design of the project, to the initial technical project, or we could need different components. So the change in the physical artifacts can require more costly production processes or more costly components, so that and so also higher investment for production capacity. And clearly this is something that can affect the initial investment and that we could account for when estimating the initial investment. The other type of contingency is financial contingency. Financial contingencies are related not to the technical characteristics of the product or the services or of the production process, but are related to the prices of the raw materials, component, and production processes. So what can happen here is that some prices of the fixed assets that we need for the project could increase for unforeseen reasons. For example, we could have a higher inflation rate than expected, or we could have a price escalation related to a specific component or raw material. For example, a sudden increase in the oil price that we could not expect at the beginning. So in these cases, we could account for part of this unforeseen event and increase our provision, our expectation of the initial investment. Clearly here, contingencies are not easy to be estimated because we are talking about very uncertain events that could happen but also could not happen. So on one side, it's fair to account for contingencies in the estimation of the initial investment required by a project, but on the other side, we have to use them very carefully in order not to arrive to an overestimation of the real investment cost of the project, then will bring to wrong results in the financial analysis. Okay, so far we saw two components of the initial investment: fixed assets and pre-operation expenditures. So now we have the last component of the initial investment, that is the net working capital. So what is net working capital? Well, at first view, the net working capital can be defined as a difference between the current assets that are used and deployed for the project and current liabilities that are the short-term liabilities that are generated by the project. Before looking into the details of these current assets and current liabilities, let me give a general definition of them. So for current assets, we intend all those assets that are used by the project but that have an expected life of less than 1 year. So they are short-term assets. So they are different from fixed assets because fixed assets, as we say, they have an expected life of more than 1 year, whereas current assets have an expected life of less than 1 year. In the same way, current liabilities are liabilities that has an expected life of less than 1 year and they have an operating nature. So in this case, for current liability, we mean all those liabilities that are created by the operations and are not liabilities that are specifically generated instead for the funding of the process of the project. So let's look at the definition of current assets. In current assets, we typically identify these items. Inventories. Inventories can be related to raw materials, component, work in progress, or finished goods. In other words, what happens is that the project is generating this kind of assets because you need to buy a stock of raw materials before you start the production. These raw materials will be consumed during the life of the project. Then you need components that are used in the production process. And sometimes during the production process you have work in progress that is stocked into some warehouse. So it's again an asset that is generated by the project. And then you could have also a stock of finished goods because you typically stock finished goods before selling them on the market. These stocks are normally consumed during a year, so that's why they are defined as current assets, because their expected life is shorter than 1 year. Then you have cash in hand. So cash in hand is the cash that the firm needs to keep available in order to pay the suppliers. So the project requires buying raw materials, components to pay the employees and so on. So the firm is constantly to have some cash available in order to satisfy the operating needs. And this cash is defined as cash in hand. And then we have the accounts receivable. So the accounts receivable refer to those parts of the revenues that have not been paid yet. So it typically happens that you sell the products to the clients, and then the clients do not pay you immediately, but pay you after some days. So typically clients pay you after 30, 60, 90 days. So when you sell the products, instead of getting immediately cash, you will create a new accounting item that is accounts receivable that will disappear in the moment the client will pay for the products they bought. So accounts receivable is another item that is normally a life shorter than 1 year that is generated by the operations of the project and is included therefore in the current assets for the calculation of the net working capital. Instead, in the current liabilities, we typically found other items. First of all, we have the accounts payable. So the accounts payable are the opposite situation as compared to the accounts receivable. So what happens here is that when you buy raw materials and components from suppliers, it typically happens that you don't pay your suppliers immediately, but you pay them after a given period. So when you buy the raw materials and you don't pay them immediately, instead of having a cash outflow, you have the formation of an accounts payable. When then you will pay for the raw material, the accounts payable will disappear and you will have a cash outflow. So in other words, accounts payable are liabilities towards the suppliers that allow the firm to fund at least some part of the current assets that is said of generated by the project. Another component of current liabilities are the advances received by the clients for products and services were not sold yet. So in this case we have a liability towards the clients because they paid us but we have not delivered the product or the service yet. And therefore, from an accounting point of view, these advances are equivalent to a liability. And again, advances received are a source of funding of the current assets that are part of the net working capital. And finally, you can include in current liabilities any other short-term operating debt, so any other debt that is generated by the operations of the project, and is a life shorter than one year. So now the problem is how you estimate the need of net working capital. So the next topic we'll discuss is net working capital estimation. So the typical way you estimate the net working capital need for a new project is through the estimation of the specific component of the net working capital, so of the specific component of the current assets and the current liabilities. So the typical way you estimate the specific component of current asset, current liability is looking at the coverage. The coverage is a parameter that is typically expressed in days. And in order to understand that better, let me give an example. Let's assume that we want to know what is the coverage of the raw materials for this project. So let's assume that we know what is the daily consumption of raw materials. When we know the daily consumption of raw materials, we can at this point specify what is the coverage that we want in terms of days of consumption of raw materials. So if we say that we want 60 days of coverage of raw materials as a stock in our warehouse, this means that at each moment we will have a stock of raw materials equal to 60 days of consumption. So saying that raw materials have 60 days of coverage means that we have a stock of raw materials that covers 60 days of consumption of raw materials. So this is important because once that we define the days of coverage of any given item of the working capital, we can easily calculate the value of each component of the working capital. So if in this formula we define as WC with J the value of the J's element of the working capital, we can easily calculate it as applying this formula. So this formula is a product between a ratio and a basis. So the ratio is the ratio between the days of coverage for that specific item of the working capital and 360, that is the conventional number of days that you have in 1 year. The basis is the variable, the operating variable that is generating the working capital. So in the case of raw materials, the basis for the calculation is the annual purchase cost. So you know that, for example, as we'll see in the next slide, you have a given purchase cost for raw materials on an annual basis. If you have 60 days, that is 2 months of coverage, then the value of the raw materials in any given moment will be 2/12, that is 1/6 of the purchase cost. But then we'll see an example that will clarify this, the application of this formula. But what this formula is showing is that in order to calculate any component of the working capital, you need an assumption about the days of coverage that we already discussed, and you need the assumption about the basis for that specific item of the working capital. So each of the component of the working capital is a specific basis that is generating that component. So we have receivables are generated by revenues, in the sense that the higher the revenues, higher the receivables, you expect that the project is generating. Then you have payables that depends on the production cost, in the sense that the higher the production cost, the higher you expect the payables will be for this project. Then you have, as we discussed before, the raw materials typically depends on the annual purchase cost. And then you have the finished product stocks that depends on the production cost of a year. And then you have the cash in hand that are related to the operating needs, and so they can be calculated on the basis of the operating cost. Clearly the choice of the basis is discretional. So the basis that you find in these tables are not exhaustive. You can find other bases, they are just a suggestion. The important is to find the basis that is generating that component of the net working capital we are interested in. So here we have an example of the calculation of raw materials for the estimation net working capital. Let's assume that we have days of coverage equal to 60, so we want to keep a stock of raw materials equal to 60 days of consumption. The basis is the annual purchase cost. We are assuming that the annual purchase cost of the raw materials is 1,200. At this point, we can easily calculate the value of the raw materials, taking the days of coverage, dividing these days of coverage by the number of days in a year, and multiplying this ratio times the basis that in our case is the annual purchase cost and is equal to 1,200. So in the end, it's possible to estimate the need of raw materials for this project equal to 200. So at this point, we have completed the analysis of the three components of initial investment, that is fixed assets, pre-operation expenditures, and net working capital. So now we have last topic for this lesson, that is depreciation. And as I was saying at the beginning of this class, depreciation is important to understand the dynamics of the fixed assets over the life of a project. So what is depreciation? Depreciation is an estimate of the fixed assets consumed per period. So I make a simple example. I buy a new plant. I expect that this plant has an expected life of 10 years. In the most simple case, I expect that this plant is used evenly during the life of the project, so there is a constant depreciation. And so each year I will have a depreciation equal to 1/10 of the value of the plant that I bought at the beginning of the project. So the depreciation is needed in order to account for the consumption of the fixed assets during the life of the project. It's important to remark that depreciation is a non-cash accounting item. So this means that from an accounting point of view, I include depreciation in income statement to account for the cost related to the consumption of the fixed assets, but the depreciation does not imply any cash outflow, because the cash outflow is concentrated in the moment I buy the asset, and after that I won't have any cash outflow. So depreciation is a non-cash nature, so it does not imply any cash outflow. When I fix depreciation, clearly the first aspect that I have to define is the expected life of a project, and then estimate the annual consumption of the fixed asset based on the expected life of the asset. In doing that, I have to distinguish the technical versus economic life. What does it mean? For example, I could have a plant that is an expected technical life of 10 years, so the plant can be used for 10 years, but it can happen that the product becomes obsolete after 8 years. So even though the plant is a technical life of 10 years, it is an economic life of 8 years, because it's the maximum period I can use the plant before the product is not sold anymore. So in this case, the correct parameter to consider should be the economic life. However, depreciation is typically regulated by the national accounting and tax regulation, and so it depends on the consumption rates that typically are fixed by the regulating authority. And what is also important to remark is that depreciation is relevant for tax purposes, is depreciation is a deductible cost. This means that depreciation reduces the pre-tax income, and therefore, as a consequence, reduces the taxes that in the future years the company will have to pay on the profits generated by the project. So depreciation is anyhow relevant for even though it's not generating cash outflows, will be relevant for the financial analysis of a project, because it is an impact on taxes, in particular is the effect of reducing the taxes that the company will pay for this project. So there are different ways to depreciate fixed assets. So we can see here the main methods for depreciation. The most simple method for depreciation is straight line to zero. So we'll see an example in the next slide of straight line to zero depreciation. Here it's anyhow important to provide an initial definition of this method. So here what means is that you take the value of the fixed asset, that is the historical cost, that is the price you pay to buy this asset. Then you assume the expected life of the asset depending on economic and technical characteristics of the assets. Let's assume that the asset has an expected life of 5 years. You just divide the historical cost of the asset by 5, and each year you have a depreciation that is constant and is equal to the historical cost divided by 5. So the final value of the fixed asset will be 0, because if you sum all the depreciation, in the end the net value of the asset after all the depreciation will be set to 0. The straight line to salvage value is basically equal to the previous method, but it's different because the value of the asset, the final value of the asset, is not set to 0, but is set to some salvage value. So this means that you are depreciating always the same cost, but you're assuming that the final value of the asset at the end of its life is not 0, but is higher than 0 because you expect to sell this asset at a price at the end of its life. So in this case, the value of the depreciation is lower because instead of setting the final value to 0, you're setting the value of the asset to a value that is higher than 0. So total depreciation will be lower, and also the annual depreciation will be lower. But also in these cases, in the first method, you will have a constant annual depreciation. Finally, you have accelerated depreciation. Accelerated depreciation is typically allowed for tax reasons. So it can happen that in order to force some specific investment, local tax authorities allow the firm to depreciate the asset faster in the initial years of its life. So the depreciation at the beginning will be higher than at the end of the life of the project. This is potentially important for a firm because this allows a firm to pay less taxes in the initial years of the life of the project. And so there is a tax benefit that in theory should incentive some specific types of investments. So now we can conclude this lesson with a simple example of the straight line to 0 method for depreciation. Here in this table we are assuming that the project requires to buy a fixed asset that has an initial value of 1,000. And we assume that the expected life of this asset is 5 years, as we can see in the first column on the left of this table. So the other assumption we are making for this method is that at the end of its life, the book value of the asset will be equal to 0. And at that point, we are assuming that we have a constant annual depreciation. So in this table, year 0 conventionally refers to the moment when we buy the fixed assets, and year 1 to 5 are the years of the life of the project when we'll use these assets. So in year 0, what we can observe in the table is that we have the book value of the fixed asset equal to 0, and clearly we are not started yet to depreciate, so annual depreciation and cumulative depreciation will be equal to 0. So when we get to year 1, with the first annual depreciation of 200, so the book value of the fixed asset will reduce from 1,000 to 800 for the effect of the annual depreciation. Cumulative depreciation will pass from 0 to 200. So the second year we'll have a new annual depreciation of 200. As effect of this depreciation, the book value of the asset will pass from 800 to 600, and cumulative depreciation will pass from 200 to 400. As we move from year 2 to year 5, we'll have 3 more annual depreciation of 200, and the book value will be decreased accordingly until arriving to the value of 0, that is the value that we set as a final value for this asset at the end of its life. And you can see that also cumulative depreciation increases until reaching 1,000. So when we arrive at year 5, cumulative depreciation is 1,000. This means that we have fully depreciated our fixed assets and we don't need any further depreciation. So with this example, we have ended this class. I remind you that you can find additional information on the topics of this lesson on course website, and I thank you for your attention.